Welcome to the Explainer. All right, today we're going to decode a financial statement that honestly can tell you more about a company's real health than pretty much anything else. We're talking about the cash flow statement. Think of it as the ultimate guide to following the money trail.
So, let's kick things off with a puzzle. And this is one that stumps even really smart investors. You see it in the news, right? A company announces these amazing, record-breaking profits. The stock price shoots up. And then, a few months later, poof, they're bankrupt. How on earth does that happen? It sounds totally impossible. But believe me, it happens way more than you'd think.
Well, the answer isn't really about profits at all. It's about cash. And as our source material from the CFA Institute puts it so well, a company can look like it's killing it with booming sales on paper. But if there's no actual real cash coming in the door to pay the bills, to pay salaries, to pay suppliers, that company is headed for serious trouble.
And this brings us to a super important idea, something you should really remember. Profit is an opinion, but cash is a fact. You see, profit is calculated with all these accounting rules. A company can record a huge sale the day they sign the contract, even if they won't see the cash for months. So, profit is useful, for sure, but it's just not the same thing as having cold, hard cash in the bank to keep the lights on and, actually grow the business.
Okay, so to solve this whole mystery of the disappearing profits, we need the right set of tools. When you look at a company's financials, there's usually this trio of reports. You've got the income statement, that's kind of like its report card. Then there's the balance sheet, which is more of a snapshot in time. But the one we care about today, the real star of the show, is the cash flow statement. I love this analogy. Think of it as the detective's notebook. It tracks every single dollar and tells you exactly where it went.
So here's what makes this statement so incredibly powerful. It's not just one big confusing number. It actually breaks the whole story of a company's cash into three really clear chapters, or activities as they're officially called. And each one tells you something different about what's going on with the money. So let's break them down, one by one.
First up, we have operating activities. Think of this as the company's engine room. It's all the cash that comes from its main day-to-day business. So if we're talking about a food truck, this is the money they make from selling tacos. Simple as that. And here's the bottom line. A healthy company has to be generating positive cash flow right here, from its core business.
And you can see here, it's really a two-way street. Cash flows in when customers pay up. But of course, cash also has to flow out to pay for all the stuff you need. Inventory, salaries, rent, taxes, you name it. At the end of the day, the goal for any healthy business is dead simple. You want more cash coming in from operations than is going out. Period.
All right, our second chapter is investing activities. Now, if operating activities are all about the day-to-day, the present, then investing activities are all about the future. This part of the statement tracks how a company is spending its cash on big, long-term stuff to help it grow. So for our food truck, this isn't about buying more avocados. It's about buying a whole new, bigger truck, or maybe even a brick-and-mortar restaurant.
So when a company sells off an old piece of equipment or a building it doesn't need anymore, that's cash coming in. When it buys a brand new factory or new computers, or even buys another company, that's cash going out. This section tells you a ton about how much a company is betting on its own future.
And that brings us to our final chapter, financing activities. This part of the story is all about where the company gets its money from, other than its own customers. We're talking about its relationship with its owners and with lenders. So for that food truck, this would be the bank loan it got to start the business, or maybe the money an investor kicked in.
You see the pattern here, right? Cash comes in when a company issues new stock to investors or takes out a loan. And cash goes out when it pays back that loan, buys back its own shares, or pays dividends to its shareholders. Basically, this section shows us a really important dynamic. Is the company taking in money from the outside to fuel its plans, or is it healthy enough to start returning money to them?
Okay, so we've got the three main chapters of the story down: operating, investing, and financing. But how do you actually read the statement and figure out what it's telling you? There are a couple of little details that are super important to know, and they'll make you a much smarter reader of these things.
So first off, companies have two ways they can tell their operating cash story. There's something called the direct method, which is just a simple list of where cash came from and where it went. But honestly, you'll almost always see the indirect method, and it's actually kind of brilliant. It starts with that net income number, the profit, and then it shows you all the adjustments to get back to the actual cash number. This is the very thing that solves our puzzle from the beginning. It explains why profit and cash are so different.
Here's a quick but really important heads up, especially if you're looking at companies from different countries. The accounting rules aren't the same everywhere. Most of the world uses a standard called IFRS, but the US has its own, called GAAP. And as you can see, they treat some things differently. Under IFRS, a company might have a choice about where to put something like interest paid, but under the US rules, it's much more rigid. It's not about one being better or worse, it's just something you absolutely have to know if you're comparing, say, a European company to an American one.
So all of this brings us to the million-dollar question, right? What does a healthy cash flow statement even look like? How can we use this to tell if a company is strong or weak? Let's stop talking theory and look at a real-world example from our source material to see exactly how this works. Okay, take a look at these numbers for Walmart from back in fiscal year 2010. Their net income, their profit, was almost $15 billion. That's a huge, impressive number. But look at their cash from operations. It was over $26 billion. That is way, way higher. So what in the world is going on here? How can those two numbers be so far apart? And here is the big reveal, the key rule of thumb. For a healthy, established company, you almost always want to see its cash flow from operations be higher than its net income. And a big reason for that is an accounting item called depreciation. See, companies get to subtract the wear and tear on their buildings and equipment from their profit, but no actual cash leaves the building for that. It's just an accounting entry. So the cash flow statement very cleverly adds that number right back in, which gives us a much truer picture of how much cash the business is actually generating.
All right, so let's boil all of this down. What are the big things to take away? First, and say it with me, profit is not cash. You always have to look deeper than the headline profit number. Second, cash from operations is absolute king. A company has to generate cash from its main business if it's going to survive in the long run. And finally, remember that these three sections, operating, investing, financing, they tell a story. Are they growing by delighting customers, or are they just surviving by taking on more debt? The statement tells you.
So there you have it. You now have the tool you need to be that financial detective, to look right past the flashy headlines. The next time you see a news report where a company is bragging about record profits, you'll know what to do. You'll know to ask the real question, the much more important question. That's great, but show me the cash.